last year, my stock market portfolio made $66,000 from growth alone, and my total portfolio today is sitting at around $400,000. What might surprise you is that I don't do anything complicated. I've never had a six-figure income, and I don't try to time the market. Let me show you my portfolio and tell you about the 3 guiding principles that will help you outperform most stock market investors. Number 1, buy index funds. This is not only the simplest approach to investing, but it's also going to guarantee that you get your fair share of the stock market. And it's also, ironically, one of the hardest things for most people to accept because it kind of goes against how we approach most of life. In life, we do not settle for average. However, when it comes to investing, this is exactly what you want to do. Because we don't want to settle for average, what is tempting to do for us in the stock market is to chase performance and try to time the market without realizing that this is actually hazardous to wealth building. As a first-time stock market investor, one of the mistakes that I've made has been thinking that I needed to have a volatile asset in order to build wealth. I thought that I needed the best performing asset. And that's exactly how I lost $10,000 in 2014 trying to buy something that I didn't understand. And really, it wasn't my fault. I had no financial literacy, and there was somebody in my circle who actually asked me if I wanted to do this, and it ended up being a Ponzi scheme. It was such a bad mistake. But it came from this naive temptation to chase performance. And the thing that I beat myself up over is that I had a Roth IRA at the time. I was even investing in some index funds through a financial advisor. And I don't know why I didn't just put that $10,000 towards that instead. I really did think that people became rich through taking these risky investments. Yeah, I was totally wrong. When I ended up investing outside of my 401k and managed account, I ended up following the Boglehead investment philosophy. And this comes from Jack Bogle, who actually invented index funds. And he argues and shows very clearly how investing in index funds is how to build wealth over a long period of time. And if you don't know what an index fund is, it's basically like this basket of funds, and inside are going to be shares of every company that tracks a certain index. For example, like the S&P 500. In that basket, you're going to have the top 500 companies of the US. And there's a bunch of different indices that you can get. That's just one example. And the cool thing about index funds is that they give you diversification across hundreds of companies in just one single purchase. And it's not just this like easy button that you get to press. The data actually shows that 90% of investors who buy index funds outperform actively managed accounts. But don't take it from me, take it from stock market investing legend Warren Buffett, who said, most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Those following this path are sure to beat the net results after fees and expenses delivered by the great majority of investment professionals. To increase diversification even further, the portfolio that I aim to have is a 3-fund portfolio where one part is bonds, one part is domestic stocks, and then the other part is international stocks. This is something that I'm working towards, but my current portfolio doesn't currently reflect that, but it will over time. So let me show you what my portfolio currently looks like. But before I do want to mention that this is not financial advice. The funds that you choose and the asset allocation that you have should be customized to you. It should be based on your goals, your timeline, and your risk tolerance. And people on the internet, like myself or otherwise, have no idea what any of those variables are for you. And we have no idea what your full financial picture is, and legally, we're not allowed to tell you what to invest in. The internet is great for education and inspiration, which, don't get me wrong, will go a very long way. But if you're looking for custom advice beyond education and inspiration, I highly recommend working with an advice-only advisor. You're going to want to meet with someone who is a fiduciary, meaning they legally have your best interest in mind, and they're not going to try to sell you one of their products. Trust me, I have had a really bad experience with this where I basically declined somebody's product that they were trying to sell me, and they made me like cash out of my Roth IRA. It can get weird. And the other great thing about advice only professionals is that they're not going to charge you an assets under management fee. And in the next section, I'll tell you how much that can actually cost you. So if you want specific advice, I highly recommend Nectarine. You can use a link in my description and find a friendly financial advice only advisor. So let me show you the portfolio that has allowed me to beat a lot of investors. In my 401k these days, I am automatically purchasing BSPAX, which tracks the S&P 500. In another account, they mostly have VOO, which also tracks the S&P 500. And in my last account, I have FXAIX, which also tracks the S&P 500. And you'll notice that I do have a few other things that reflect past decisions that I've made and sort of just kept it there. But like I mentioned earlier, I am moving closer to a 3-fund portfolio over time, and this is just sort of what it looks like right now. This simple approach has allowed me to build wealth on a modest income, and it's also given me the peace of mind, especially during these times where the market is just having some interesting behavior, just because I know over time the market has always recovered and is always reaching new time highs. Number 2, keep fees low. If you want to outperform most stock market investors, you need to keep your fees low. Before I switched my 401k to purchase the S&P 500, I actually went with one of those default options that they show you during onboarding. And what I didn't realize were the fees associated with that. I don't know if I had access to those fees or if I even knew to look at them. After learning about investing and what fees to actually be looking out for, I realized that I was way overpaying in fees inside of my 401k. And the other type of fee comes from a financial advisor, and typically that is called an assets under management fee. And a lot of people who have a financial advisor don't actually realize that they're paying this fee. The other day I was chatting with someone and I asked her how much she's paying to her financial advisor, and she said nothing, like that her financial advisor wasn't charging her anything. And to someone who doesn't really understand how the industry works, it might appear that way because you're not actually getting billed necessarily in a straightforward way by your financial advisor, but the truth is that they don't work for free. Usually what they'll do is charge you a 1% AUM fee. And even though that kind of seems low, it's actually kind of crazy how high it is. Let's compare that to how much I'm paying right now. I pay an about 0.04 expense ratio, but you know what? Let's be a little more conservative and use a 0.1% fee against a 1% fee. So let's take an example of two investors where they are investing in the same exact thing. Let's call it the S&P 500, so we can assume before fees there is a 10% annual growth on average. And let's say they are investing $10,000 every single year into this investment. Person A, who has a 0.1% fee, is going to end up with about $1.6 million. What about the other person? The other person who is paying a 1% fee is going to end up with about $1.3 million. That is a difference of about $250,000. That is how much a 1% assets under management fee can cost you over 30 years. That's exactly why I choose to keep my fees super low. I'm going to be keeping most of my wealth, not some other person that works in the financial industry. While it might seem obvious on the surface to keep your fees low, most people have no idea the impact that these fees have on their wealth over a long period of time. There is one more thing though that you really have to know if you want to be able to outperform most investors. Number 3, tune out the noise. This has been crucial for my own success, especially right now. If you want to outperform most investors, you're going to have to learn how to ignore the noise and stick to your simple, diversified plan. And look, I get it. It is human nature to stop the bleeding. When you see your portfolio tanking, you want to just run in there and prevent further loss. And that's exactly why people will take their money out of the stock market when it's having sort of a down moment. But did you know that 42% of the S&P 500's best days have been during down markets? We just have no idea when the best days are going to happen inside the stock market. That's why it's so important to stay invested and just to tune out the noise. Because if you take your funds out, guess what? When the market goes up again, you're going to miss out on that recovery or that gain. If you miss 10 of the best days in the stock market, you can miss out on the majority of your returns. And again, this is really simple advice, but why is it so hard to keep? Every single day, we are being bombarded with financial media. It's telling us about market predictions, economic forecasts, and even warning us about the next crash. But don't forget that the media's job is to sensationalize things. They want your attention and they are getting paid to get your attention. So of course, the titles are going to be extreme, but also when it comes to financial media, there's incentives that they have as well that don't really match up with your best interests. Wall Street wants you to believe that by working with them that they will be able to beat the stock market and that they will make you rich, but in reality what they're doing is they are making themselves rich. If I let this media affect me in 2022 and even earlier this month, I would have missed out on some of the best days in the stock market. In fact, let's rewind just to the beginning of this month, April 2025, where the tariffs were announced and the stock market took a huge dip. But then just days after, we saw one of our best days in the S&P 500 like ever. I've learned to tune out market forecasts because the truth is nobody knows what's going to happen, not even professionals. I've also learned to basically ignore short-term fluctuations, and I resisted the urge to make portfolio decisions based on news. And instead, I focus on what I can control, which is continuously investing consistently, regardless of what's going on in the world or market conditions. And I've maintained my risk and age appropriate asset allocation, and I remain to stay the course throughout any volatile periods. And here's the thing, the people in your immediate circle probably are not making the best decisions, so it might be good to actually ignore them as well. Just like your heart rate goes up and down, so does the stock market through corrections, crashes, and bear markets. This is the nature of the stock market. There's always going to be some new event that brings the majority of people to an extreme place of fear. But again, historically, the market has always recovered. But hey, something I'm really well aware of is the 1929 stock market crash. It took us 25 years to recover from that, and that's not something that I ignore. But what it does do is it informs the posture that I choose to take as a stock market investor, and it also informs how I choose to spend my money and my time. I choose to take the posture of humility because the truth is nobody knows what's going to happen in the future. I choose to prioritize my relationships, faith, and my skill development just because I know that no matter what happens, if I have that, I will be able to really weather any storm. Those are non-negotiables for me. So don't forget to tune out the noise because the market rewards patience. It does not reward reaction. By understanding that the noise around the market is designed to trigger emotions and not help you make better decisions, I've gained an advantage over a lot of other stock market investors. My journey to building a $400,000 stock market investment portfolio on a modest income as a first generation investor hasn't been about finding the magic stock at the magic time. It's been about applying these simple 3 principles: buy index funds, keep fees low, and tune out the noise. This approach really isn't flashy or exciting, but it works. It's allowed me to capture strong returns and ride out any turbulence in the market. And I've been able to focus my energy on things that actually matter to me instead of just like managing my portfolio. Don't forget that successful investing is not about outsmarting the market. It's actually about not outsmarting yourself. By embracing these principles, you can potentially outperform most stock market investors without having to spend hours analyzing stocks or watching the market movements. And I'm curious to know, which of these 3 principles do you find the most challenging right now? Let me know in the comments. I would love to get to know you a little bit more. And if you're looking for feedback on your own portfolio or would like to learn how to get started with the help of a advice-only professional, don't forget to check out the link in the description. And hey, I'm on a mission to help 1 million women reach their next financial independence milestone. So if you are FI curious, or if you just want to watch me reach my next goal, I invite you to subscribe to this channel and like this video so my next video gets shown to you. In this channel, I'm going to be talking about my own financial independence milestone updates. I'll be sharing stories of other women who are pursuing FI on different incomes, and I'll be sharing financial independence education. And if you'd like to know how I've managed to invest $5,000 every single month on average for the last 4 years on a modest income, I think you're really going to like this video on the screen. I'll see you next week.